do not be that asshole. There are plenty of stories out there of respectable VCs not picking up the phone when it's the bad times. We are a commoditized product, Harry. VCs are a commodity. You can press them down. Fundamentally, the idea of collecting a 2.5% management fee does not really make sense. It does not align us with the outcomes. If we can't imagine 100x, we should not be entertaining the idea of this deal.
Ready to go? Taavet, dude, I'm so excited for this. I've wanted to make this one happen for years. So thank you so much for joining me.
Finally, I'm so glad to be here.
Well, dude, the pleasure is all mine. Now, I want to start before Plural. You were a prolific angel. Can you just start on the investing career there, how it went, whether you liked it, and the transition to Plural?
So I made my first angel investment probably about 20 years ago. And I think, through the years of building Wise and still working at Skype, I met other people who were building businesses. I was excited about what they were doing. I wanted to be part of the journey and wrote the small angel ticket. I went into overdrive once I stopped running Wise, doing 30, 40, 50 deals a year. That was fun, But I think it started feeling to me a little bit Wall Street-esque, high-speed deployment. I think it was a great portfolio strategy. I think the portfolio has done really well, but it felt it wasn't very kind of mission aligned. I thought there is something more that can be done. And that's kind of was the beginning of thinking, hey, we should start Plural. We should really think about getting founders who have scar tissue from building companies to become investors.
What was the single best investment from that period?
So one of the things I missed out on investing in Bolt's seed round. I was too busy building Wise. But then a couple years later, I was really impressed with Markus, and I spent a bunch of time, and I spent a lot of my limited liquidity buying up secondaries in Bolt in 2017.
Love that. I mean, Markus is fantastic, and what a great story. I just want to start then with a core question, which is, you said there about it felt a little bit like Wall Street. That kind of hit when you said it, because it made me think of Doug Leone, who said on the show to me that venture has turned from a boutique cottage industry into a commoditized, high volume industry. Do you agree with that transition from boutique community to high volume commoditized industry?
I think a lot of that rings a bell, but I think we need to unpack it a little bit more. I think, it's very different if you're talking about deploying big checks in mid or late stage. It's very different if you're doing high-speed investing in early stage, kind of what I did as an angel. It's very different to what we do at Plural, which is backing the most ambitious founders. And sometimes there's no one else who wants to back them. I think we need to unpack this into different parts of the venture ecosystem, and different parts, I think, are going through different journeys.
You said before, I saw this and I was like, this is just too good not to start with it. You said VCs are spreadsheet monkeys who have no idea how to run a business. Can you unpack that for me, Taavet?
I think what I meant by this is that if you are looking at a mid-stage SaaS company, consumer company, where all you need to do is stack up the cohort curves, take away the CAC, multiply by LTV, and then pay a very high price to win the deal, that is not very exciting to me. And that's what I mean by spreadsheet monkeys. I think, but if you're talking about early stage, when you're really looking the founder deep in the eye, trying to figure out why is he doing it, what is his unfair advantage to build a generational business, I think that's very different. And there's some things that I've said many times is that if you look at the European landscape, vast majority of the European GPs have not spent a single day working in a real company. They've worked in consulting firms, banks, but they haven't worked in a real operating company. And I think the scar tissue you have from working in an operating company, or even more, the scar tissue you have from building, being the founder, being the CEO, is very different.
There's two elements that I want to unpack there. The first you said about kind of the movement away from the spreadsheet investing. I had Nabil from Spark on the show, who has made some great investments recently in your granolas, but also your Anthropics of the world. And he said that we're actually leaving that era, that predictable SaaS growth era is over. You see companies like Lovable, Bolt, Macaw, Midjourney, you name it, where revenue trajectories are unparalleled. And that SaaS predictability era is over. Do you agree that the era of like spreadsheet investing and predictable SaaS growth is over, and we're now in this unbelievably unpredictable time?
So there's a lot more unpredictability, but I think there is still, companies that are on a growth trajectory. I think they will look somewhat similar and, more spreadsheet-like. And they need capital and people need to give them capital. There's nothing wrong with that. But that's, maybe even more similar to what public market investing used to look like a long time ago. But I think if you're talking about trying to spot the next trillion-dollar company, I think that's a lot harder. Maybe even harder now than it was back in the days because competition is bigger in some sense. There are more people trying.
You mentioned the majority, I think you said before, it's like 8 to 12% or whatever, that have actually had like operating experience in real companies in venture in Europe. How does, just pre-service and working with founders, how does the mindset differ when comparing an investor who doesn't have any operating experience to someone who does have a lot of operating experience when it comes to actually investing and picking the companies to work with? How does that mindset differ, do you think?
It's about the ability to assess the founders and think about what could this look like once we get to product market fit. When you have product market fit, when you have metrics to look at, I think everything becomes a lot easier. So the challenge is really before that. And then a big part of it is also, we're 5 partners at Plural. We've all built companies before. We've all raised money. We've either raised money or tried to raise money from pretty much everybody who was around 10 years ago. It's the best of the best and the worst of the worst. And every time we had the most insightful conversations with the people who had built their own companies. We got in the seed round, we got Max Levchin when we were raising money for TransferWise, as it was called before Wise. Then we raised money from Ben Horowitz. So, and same for my partners. We had the most insightful conversations with people who had been on operating journeys. And that's why we were always looking for people who were a couple years ahead of us. And we feel also now, even now when we speak to founders, they really appreciate the fact that we've been in their shoes. Does it make us a better investor? Frankly, I don't know. Time will tell. But I think it makes us better partners for the people we invest in.
If you go through the different elements of venture, sourcing, selecting, securing, which is winning, and servicing, which is helping, do you think, if we take it one by one, the operating experience makes you better at sourcing, finding companies? Like, do more founders go to you inbound because of the experience and the operating successes that you've had, or not?
Frankly, I think venture is a brand game. So if you are a new fund, the brand is a brand of the GPs.
I would say that Plural have built a brand as being, you do deep, hard shit that most other people are like, well, I don't understand that. Would you say that's a fair representation of the brand that you want to build?
We are looking to back the most ambitious entrepreneurs, whatever they're building. So we're looking at Proxima Fusion. That's maybe what you would call deep hard shit. Then we look on the other side, we have Teton, which is using CCTV cameras to monitor patients. It's not that complicated maybe. So I think we go the full spectrum. But I think it's a character of the entrepreneur which is maybe the most important. Approximately half of the founders we back are repeat entrepreneurs. We look at Torsten, who built a gaming company. Then he went into building a defense company, and he started Helsing in 2020 or 2021. So you need to have something which makes you tick differently to go building a defense company 4 or 5 years ago, before this became a hot topic.
think the world of Torsten. How do you feel about the value of serial entrepreneurship? Like inherently, I find that I feel so much more comfortable backing a serial entrepreneur. There is so much learnt through the scar tissue of the mistakes you've made before, but then others say about the benefits of naivety of being a first-time founder.
We love repeat founders. And when we look at the people we've backed and the ones we haven't backed, what stands out to us is that so repeat founders, they typically go for a much bigger goal. Torsten did a gaming company, and he went into defense. We can talk about Daniel Ecke. The first company was e-commerce, and then he took on a massive challenge of building Spotify. So we love the fact that these people, they go for a massively bigger goal next time. And again, I don't know if they have a bigger likelihood of success, but even if the likelihood of success is the same, the outcome is so much bigger. And they've learned a fair few things on the journey. Like, I don't think I would be that excited to back a founder who built fintech company 1 and then goes on to build fintech company 2.
I had Delian on the show from Founders Fund, and he said if you are a repeat founder building in like enterprise SaaS, you are doing a massive injustice. In this time when we have income inequality like never before, climate challenges like never before, energy problems like never before, conflict and defense problems like never before, you really thought the second time you'd do payroll again?
I mean, I don't. There are many great founders building great enterprise SaaS companies, but for me personally, it's pretty hard to get excited about the good old SaaS company.
I mean, I still get very excited. So that's the joy of this game, which is there's many different ways to do it.
We are complementary, Harry.
I agree totally. Do you think rich investors make better investors? I often think this with like a Sequoia of the world, because they are not scared about downside protection. They are upside focused. They are not scared of losing their jobs. They are not scared of not making money. It is solely upside. Do you think rich investors make better investors?
What I would ask about is, are they investing other people's money or their own money as well? I think there is one thing if you're a rich investor and you play with only other people's money. There's a different thing if you're a rich investor and you're investing your own money. So I think it's a question of alignment, and hopefully we'll talk more about this, but like we've thought deeply about alignment in venture and how to make sure that we are better aligned with both our LPs and our founders. And I think that to me is a core thing of like look at what a person does with their own money. And I think that's kind of the most important.
Do you think when we look at the current state of venture, it is aligned sufficiently?
I don't think it is in general. I think fundamentally the idea of collecting a 2.5% management fee does not really make sense. It does not align us with the outcomes. At Plural, we charge about half the management fee, and we think we are much better aligned. And also what it enables us to do is make a few more investments per fund. So in Fund 1, we probably made 2 more investments because of this. Fund 2, we think we'll make 4 more investments as a result. That's 4 more shots on goal. That is pretty damn important. And still, we have a fantastic team. We have 5 GPs. Everyone is being paid well, but not ridiculously.
What would you say to the GPs who say, hey, I need these fees. I need them for paying benchmark salaries against other salaries for other firms which are the same. I need a platform team. I need a head of talent. I need you name it.
Earn your right to do it. When hiring people for a startup, you want to hire the people who are dying to work to build this company. You don't want to hire the people who are coming here for the biggest salary. Yes, you want to make sure they are compensated ridiculously well if things go well. I am very proud of the fact that when we built Wise, everybody had stock options, including every customer support agent. And I think the customer support agents who joined in the beginning, they all made $1 million when Wise went public. I'm super proud of this. Similarly, in venture, the team and GPs, once we have this magic DPI, they should make lots of money. But I don't think people in venture should make a lot of money just because they are deploying capital.
Do you blame the VCs or do you blame the model? Because like fundamentally, like it's just a game of human incentives. And when you said that DPI liquidity is so backdated now. I mean, it is so elongated in a way that it hasn't been 15 years ago or so. Like it's really 15 to 17 years before most funds are seeing DPI meaningfully. Do you blame the GPs?
I think it's a game. Don't blame the player, blame the game. So I mean, obviously it goes both ways. But it's I think as the industry evolves, maybe things will change, and we're hopefully doing our part to make this a better game for everyone.
Do you worry about the elongated window to DPI and liquidity, especially for some of the projects that you do? These are such hard projects. These are multi-decade journeys. Isn't it even longer for some of these projects?
I do worry, and I think overall we need to come up with better solutions for some of the long liquidity problems. Some of these companies may need billions, but I think at the same time, if the companies are well capitalized, they can reach milestones, then you have liquidity. The best example of all is maybe SpaceX today. It's a private company, has had zero liquidity issues. So there is a secondary market always open. It's because, the journey in the beginning was very hard, but being able to attract the capital to get to a place where you hit your milestone and make progress. So especially in the what you call crazy companies that we back, it is definitely harder. But I think we need to make sure these companies are hitting milestones, creating value, even if revenues take longer. And I think then there will be opportunities.
Do you think the 10 and 2 traditional venture model in terms of timeline needs to be updated, especially for a generation of companies that you invest in?
10 years is short. If I look at, maybe looking back now, Wise now looks like a simple fintech company. Everyone is doing fintech companies. It took us, we started working on it with Christo in 2010. We launched beginning of 2011. We went public in 2021. That was a 10-year journey. But also, to be honest, the last 3 years were probably pretty liquid, even we were private. So let's call it 7 years. And maybe for deep tech companies, it's 10 to 12. If you hit the bad patch in the markets, it becomes 15. I think we need to recognize this. But I think also maybe at some point people just need to be more disciplined in returning some capital early. There are some investors out there who are very vocal. I think Fred Wilson has spoken a lot about taking some money off the table.
We mentioned like fees and that structure as like a misalignment in the industry. Are there any other misalignments you think that are very prominent that we don't speak enough about?
Skin in the game, fees. I think there are some other kind of
When you say skin in the game, you mean like the GP commits?
Yeah, GP commit. I think, I don't think venture should be a rich people's area only, but, we're pretty, but kind of going back to what we spoke about before, look at where someone invests their own money. Like, we are the biggest investor in the fund ourselves. And additionally, every deal we do, the lead partner of the deal writes a personal check. So
can I be blunt? How much of the fund are you?
Collectively, we are the biggest investor in the fund. I don't think we're not going to start talking about numbers, but you're in the business. You know how much the biggest LP in a fund could be as a percent, so you can make the math.
On top of that, the lead partner will also write another check.
Yeah.
Wow, that is unusual.
We don't like the idea of playing with the house money is something that we're not so keen on. So the personal check, the size of it depends on the individual's position. So for some people it's smaller, for some it's bigger. But we want it to be something which is meaningful. So you think about like, I'm investing my own money in addition to the fund where I'm already an investor. And I think there may be a ritual part as well of wiring from your own account at the same time as we wire from the fund account.
The thing I love about this job is still after 10 years, you hear things that you've never heard before about this business. I've never heard of that before, because the GP commits one thing, but that as well is cool.
I think there might be other people who do this. We haven't studied the history of venture half as well as you have, I'm sure, but I think there might be other people we've heard, but I don't know facts, so
No, you've been building a public company. I've been studying venture, so I think yours is probably a more productive decade.
But maybe it's interesting to mention, like, there are other weird things in venture. Like, where does the idea come from that you should pay your investors legal fees? Well, we pay our own legal fees. Vast majority of venture deals, as in the term sheets, that you pay your investors legal fees. I mean, what is this about? It comes from the money you give the company. The company pays their legal fees.
Yeah.
Why does it make sense?
I think it's just the way it's been done.
And so we should continue.
And so you will pay the legal fees for the whole round?
No, we pay our own legal fees.
Okay.
Usually, the company pays the investors legal fees. Just I'll show you where it is in the term sheet after the discussion.
And so you pay your own legal fees, and the company pays their own legal fees. Fine. Where do you pay your legal fees from? The management company of the fund?
Yes.
Got you. What do you think are the areas of founder-investor conflict that people don't often talk about?
Timeline misalignment. Investors wanting their money back before the founder, which is a kind of a hard one. Like, in a way, if the founder is in it for the next 2 decades, it's a question of liquidity.
Has being an investor changed your mind in any major ways about operating? Now you see the other side of the table. Are you like, I actually get it now on this or on that?
I think maybe the biggest thing which strikes me is fund composition part. In Plural, we really don't think we have much control over fund composition.
What do you mean, sir, when you say fund composition?
Like, how many SaaS companies, how many carbon companies? You don't want to have the same risk everywhere. Yeah. You can, a company's outside and like, fuck, we have too many deep tech companies. We need a SaaS company. It's like, we're kind of okay mostly with the fact that we follow the most ambitious entrepreneurs, whatever they're building. But I can start sympathizing with the people who are saying, hey, you have this great carbon capture company. I love you, but we have 3 already in the fund. We can't add a 4th one because it starts skewing the fund composition. Like, you start learning nuance like that, which, on a deal-by-deal basis isn't relevant. But, if the whole fund is subject to the carbon markets, for example, somebody should think about it then.
Given the outlandish bets that you take, bluntly, in terms of outcomes and how ambitious they are, how do you think about portfolio construction in terms of how many you want on a per fund?
On a per fund basis, I think fund 1, we probably had a model of 25 to 30. We ended up with 31. So we do pay attention to having diversity in the portfolio.
Yeah. Do you do reserves?
We do reserves as well.
What's the ratio there?
So reserve ratio, fund 1, we had limited reserves, which was kind of less than a third. Fund 2, we kind of drew the line roughly in the middle. I think probably we end up with slightly less than half for reserves. Mm-hmm. And the reserves is still something that we're iterating and learning about the best ways of doing it. I haven't found anyone who says they've nailed it.
No, I really also don't like the uniform reserves. There's some people that say, if you get a good round, we'll always write a reserve check. I don't think that's right. I think you should actually be kind of all in or not.
Fundamentally, I agree with the idea that just doing your pro rata is a cop-out.
Yeah.
You either want to do nothing or triple down. However, I think the real world is slightly more complex. Round happens a year later. The company has done well. There is this weird signaling thing. I don't know. Some days I think signaling risk is real. Some days I think it's not real. But I think it's, I think you wanna make sure you have some kind of a more uniform way of doing it through the fund, and we're working on that.
We're going to get to decision making. I do just have to ask, I think the thing where you get in trouble with the reserves is like the communications, where people think that it's coming and then it doesn't come and you surprise them last minute. Now, I work with some of the biggest and best founders who I bring in to co-invest with us, and the thing that uniformly shocks me in communications is how much harder former founders are with founders than VCs are. VCs kind of tiptoe around founders. We don't want to get a bad MPS. And Taavet, you're doing great. But like, I'm not going to do the reserve check. And like, former founders or founders are just like, dude, you're not hitting bar. Like, this is not impressive. And they're much more direct and less empathetic in some ways. Do you think
I think this is really hard. We try to be honest, but we're also there for the founders, and we kind of promise we're not gonna give up before you. But it doesn't mean we're gonna write bad money after good money. We've told our founders we're here to have GDP level impact. If your company is not doing it, I'm sorry, we should not continue funding it. You may keep on working it, and we'll do our best to help you, but it doesn't guarantee the next checks.
How do you think about, when you say that we're here to have GDP level impact, we're going to get to Europe later, but just on the decision making, I heard that you don't have like traditional investment committees. That is like the hailed structure of decision making in venture. How do you think about investment decision making on a per company basis in the firm?
It is super simple, and it's actually very formulaic. There's a couple of things. Every investor can only do a limited number of deals per year. It looks at 2 to 3 deals per year is the right pacing. If you come saying I'm doing deal number 6, we're going to be like, hey, Taavet, what's going on? So limited number of shots on goal, skin in the game, so you're willing to commit your personal money. Third one, you write a memo about the deal. The memo starts with, why is this company important to me? We kind of like, every deal we do, we're testing like, would you be willing to be a co-founder of the company? And all the 49 deals we've invested in so far, we feel about all of them that the partner who did the deal felt like, bloody hell, this is so important, so exciting. I would love to be a co-founder of this company. So the memo starts with, why is this important to you? Let's talk about the founder. Why is it important for the founder? How can it be 100x from here? Because if we can't see that, we should not be entertaining it.
100x?
If we can't imagine 100x, we should not be entertaining the idea of this deal. So there are many great investments which are 5x guaranteed. So there are many great investors who should do this. It's not Plural. And then once we have that memo, we have an investment committee. And given that we don't vote on deals, the committee discussions are very honest, very brutal.
Can I just pause there on when's the memo sent first before that discussion?
We typically start talking about the company way before the memo. Then the lead investor says, I'm writing a memo, we're going to have an investment committee. We have a brutal discussion at the investment committee about the company. And then the ball goes back to the lead investor.
Can I just pause again? On that discussion quality, I think it's most often damaged because not all of the investors or partners' knowledge is at the same level as the lead partner. And so you've got some people who know nothing about the company and some who know a lot. How do you make sure that the partnership's knowledge on the company is at a sufficient enough level to have that quality discussion?
Most likely, we've spoken about the company a few times before over the past weeks, during our pipeline meeting, etc. There are a lot of companies where more than one partner meets with a team. So we try to bring people along the journey.
Does every partner need to meet the founder?
No, absolutely not. And I think there is probably no company where all the partners met the founders before the deal. It's typically one or few partners that meets a company. But we give a lot of trust to the individual GPs. The bar for being a GP is super high. So we give them a lot of trust. And we kind of felt that it doesn't make sense to hire someone brilliant and tell them, you have to come on Mondays to ask permission to do a deal. So going back, we have the IC, and after the IC, the lead partner goes back and thinks about the feedback. We have many cases where after hearing the feedback, the lead partner is like, hey guys, Ian, you raised great points. Karina, what you said about your experience in the market is very true, and I'm not going to do the deal. Many cases where this happens.
What's the percentage time? I know it's unfair, but is it 70-30, 50-50, 80-20?
It's probably more like 70-30. 70% gets done, 30 doesn't get done. But, we're not quite I'm not sure measuring this is the right thing and start setting maybe wrong incentives. And by the way, sometimes also there's a time factor. We look at a deal, doesn't make sense. The lead investor comes back like, hey, I'm not doing it now. 6 months goes by and hey guys, actually, I'm going to have a new IC. The company has, done what they promised or something has changed and I want to lean in now. So let's have a discussion again.
How do you feel about compressed timelines for deals when founders are going, hey, I'm sorry, I'm running a process and I need answers by Friday? How do you as a partnership feel by being put under that urgency?
I don't think it's happened to us.
We do see different types of deals.
I mean, I completely respect the fact that we need to communicate to the founders how long something is going to take. And if we tell them that, hey, we're going to have an IC on Tuesday and we'll tell you on Wednesday, it makes sense. We can get things done very quickly. We've probably gotten things done within a number of days. And if something is super competitive, we need to move, we need to decide soon. But I think generally we believe that we tell the founder what our process looks like. We try to make it compatible. I don't 2020, 2021, there was a lot of deals done, under the gun, basically. I did some myself personally, made some big losses. We even may have done some together, but it's
they were great. Those were the winners.
Definitely. So I think it depends on type of deal. I don't see the crazy companies moving so quickly. That's a momentum spreadsheet investing which starts moving way quicker.
Tell me, do you have some form of scoring voting mechanism in the partnership to give that very objective feedback to the lead partner to take home?
Not really. Not really. We talk about it. We share our feedback very, very kind of directly.
Do you think you should? So we are the same as you. And people say to me, it's very helpful to have a historical record so you can see bluntly how the partnership picks and thinks over time. And you can look back and go, Taavet, historically.
We keep notes directionally because I think it does help calibrate. And, I think in an ideal world, we want to come back to it years later and say, hey, let's recall that IC and what do we learn from it?
Is there anything that you think you should change about your decision-making process?
Absolutely not. We're brilliant.
On the reserve side, how does the reserves decision-making look?
So the reserve, follow-on checks, we flip it around. On the reserve decisions, or second follow-on checks, as we call it. The lead investor writes a memo, comes back with a proposal, but this needs a majority vote.
Gotcha.
We feel that it's the idea of marking up your own homework. And kind of the idea of the fund is we write, 25, 30 first checks. Everyone does 4, 5, 6, 7. Doesn't matter who does more or less, really. But when we talk about the reserves, that's a finite allocation, a finite asset we need to divide up. And you cannot do that unless you take collective feedback, collective input. So we think these ones are done best collectively. We're trying to balance, how could we keep a bunch of reserves for the best companies, but you don't know the best companies. So next round, you might not know it's a round after next either. But how do we do our share to help the companies forward in the next fundraise? Which oftentimes means doing the pro rata, which I think is a cop-out, but doing that. And then, balancing that with, can we keep larger reserves for deploying checks in companies where we are actually, at that time, maybe not confident of 100x because we've seen 10x already. But if at that point you see the momentum, and you feel, maybe it's 50x left, 30x left, you want to deploy more capital.
On the deal structure itself, we spoke about misalignments earlier. Liquidation preferences, are often now more and more under scrutiny. Maybe I'm seeing in the US, but people are now often doing deals with no liq pref. How do you feel about liq prefs as a former founder and now VC?
I don't think it makes that much sense.
Yeah.
We are here for unlimited upside, 1x downside. The difference is purely marginal. It's something if you think about, we spoke about this when we were starting to play around with this idea for Plural and thinking like, what are the structural misalignments in the industry we want to fix? I think this is one of the next things we should work on. We ultimately haven't felt it important enough. And I also, to be honest, as a founder, it feels shit. What we need to think about in the industry is how much capital gets deployed for a size of an outcome. I think founders too often think fundraising and large fundraisers is the ultimate measure of success, which I think is BS. Something that hasn't been spoken widely, even though Wise supposedly raised a shit ton of money. We probably raised $1 billion or more. Wise only raised 160 million primary capital, and we only burned through about 100 million of primary capital. 100 million primary capital to build in excess of 10 billion of value. If you look at companies out there where you've raised 2.5 billion to create 10 billion of value, and then if a company raises $1 billion at 5 billion with the possibility of getting to 8, 9, 10, maybe the liq pref is different. But early stage liq pref, I don't know, it doesn't really make sense. But
another element of term sheets is also boards and involvements on boards. Do you need a board seat with every deal?
We do not love boards, I think is a fair starting point. The things that I don't like about boards, they oftentimes become way too big, way too quickly. Your C round investor takes a board seat, your A round investor takes a board seat, your B round investor takes your C and D. So you end up with 5 VCs on the board and 2 founders. I don't think these boardrooms are any good. The other thing, I think that you want
more. Why are they not good?
Because you have 5 people with a relatively similar mindset, similar view of the world. They will be looking at maybe the guy with the biggest fund, or then the guy who wants to be the smartest guy in the room. They will dominate too much of the discussion. I think the right boards are slightly more balanced. I'm very much in favor of the idea that also founders who are building companies, at some point it might be good for them to be on one board of another person building a business. I think it's good for both.
We're seeing an increased dilution sensitivity from founders where, especially at the early stage, they don't want to dilute more than, say, a 10% on the first round or the first proper seed round. Are you seeing this increased sensitivity around dilution from founders?
We are a commoditized product, Harry. VCs are a commodity. You can press them down. Someone told me early on, which I took pretty seriously, the only person to fight for your ownership is yourself. No VC will ever fight for the founder's ownership. You need to fight for it. So there's a lot of truth in it. So, the founders, they need to fight for their ownership, absolutely. The other side of it is, it was, and still is, if you're a good fundraiser, you're building something which is deemed to be hot, you're building an AI SaaS company, it's easy to put a party round together, dilute 10%, and nobody gives a shit about the business. So I think you need to think about, do you have people involved who will help you through the good times and the bad times? In the good times, you don't care about their advice, you don't need their help, but you want someone to pick up the phone when it's the bad times. There are plenty of stories out there of respectable VCs not picking up the phone when it's the bad times. Do not be that asshole. So, but I think it also goes back to founders of actually creating a round where people have enough skin in the game to feel interested, to feel the company is important.
there's so many things I just wanted to pick up on. The best founders do not need the help of the VC. Keith Raboy said it on the show, to the point of like, we're there for founders, we're here to help you, founder value add. How do you reflect on the best founders don't need you?
Fundamentally, I agree with this. But I think, we have the ability to be very deeply involved if you need us and get out of the way rest of the time.
On the early stage being art, not a science. What worries me is like the multi-stage funds have so much money now. You're 8 billion, 10 billion, Andreessen raising 20 billion. The pre-seed and seed is literally just the massively high velocity option game. 5 on 50, fine. Doesn't matter. It's 5 million. We just want to have a chance to write 25 at the A and 100 at the B. And all that matters is it could be the next Databricks. And actually seed is being destroyed by this high volume game.
I don't think this game will last. I think the best founders will realize that getting a check on good terms from a multi-stage firm is by no means a guarantee of raising money from them in the future. I think the game will change. The industry will change. The game will change over time. But it is becoming more. It is becoming the market, more capital coming in. The question is, are we going to have more founders? Like, how do you keep it in balance? If you have more capital, then founders are getting better terms. If you have more founders, then it flips.
Do you think we have an excess supply of capital for the founder base that we have today?
Yes, in certain sectors which are deemed hot. 2021, if you were an ex-Wise employee, everybody would write a check to you without even meeting you. Does that make any sense? No. Same happened to Google employees maybe 5 years before. I do think that you need to separate kind of the early pre-product market investing from the later stage. But I think also at the same time it's safe to believe that the returns will be coming down over time as the asset class matures, becomes bigger. I think
Do you think they will come down as the asset class matures and becomes bigger, or they will go up as outcome sizes become bigger and trillion-dollar companies become more and more commonplace? I mean, trillion-dollar companies 10 years ago, we were like, pfft. Now there's several.
The best investors will continue generating best returns, but I think the median is probably going to come down over time.
If Plural does not hit the heights that you would like it to, what will be the reason?
Europe did not have enough ambitious entrepreneurs. It's them, not us.
Speaking about putting in the effort, I do want to move to Europe. You said that now is the time of all times for European sovereignty. On the why now, why is it so important now, more than ever, that Europe stands on its own 2 feet, do you think?
Even zooming out, when we were starting to think about Plural in 2021, so we raised our first fund in 2022. So thinking of creating Plural, we had 2 things which were really important: European sovereignty and GDP level impact. So that was true 4 years ago, and it's even more true now. 2 things which have happened in between. One is the Ukraine war, which, before that, investing in defense felt strange. After the Ukraine war, it feels like we need to do this in Europe. And I think the second thing which has changed is, I think really what happened in the White House in February, where Zelensky was taken for a grilling, and the way that US cannot be trusted anymore to be the protector of Europe. This kind of results in a world where we need to rebuild a lot of things on our own. We need to build our defense sector. We need to build our space sector. We need an independent energy sector. We need security, intelligence, a lot of sectors where I think we're going to be living in a tripolar world. Is that a word? Mm-hmm. Did I make it up? So there's going to be an American version. Let's call it Anduril. So there is a European version, Helsing, a Chinese version. Defense, space, energy, security, intelligence, everything, all of the critical services. And these critical services, they make up a vast portion of GDP.
Do you think our relationship with the US has fundamentally changed?
I think it has.
Does that worry you?
I think we probably were living in a slightly naive world before this. We thought human nature has changed, and we're now post-Cold War in a different world. And maybe history could have worked out differently, but I think now, looking back, I think it's still, the world is pretty similar, and the idea that we overly rely on the US probably was already wrong back then. I think we all need to punch our weight. I believe we are better collectively. Estonia is better part of Europe. UK is better being part of Europe. Europe is better together with the US. But I think we all need to collectively put in the effort. And maybe we were relying slightly too much on the US before. I don't know, but I think today...
I think when you look at NATO contributions and 75% coming from the US, we massively over-relied on the US.
Yeah. So I think that's, that's very kind of clear. But I think also what we're seeing now with the US saying, we'll sell you a 10% worse fighter jet. Right? Who is ever going to buy US defense equipment? Or, we have I mentioned Teton before doing monitoring patients. Do we want a US patient monitoring solution in our hospitals? We have a company which is making...
So why do we not want a US patient monitoring system? We have US data storage systems, we have US systems.
What if they turn this off? When they don't feel good about Europe anymore? Do we want US robots roaming around our streets collecting intelligence information? I think it's pretty clear we don't want Chinese ones.
But at what stage do you draw the line? Then you are living in a completely compartmentalized, deglobalized world where you could say that for everything. You have to.
I think I'm hopeful that...
Germany are buying $1 billion of energy a day in some circumstances from other countries because they are so woefully inadequately supplied by energy.
I think we are going into a world of decoupling for a while. I'm kind of hopeful that the Western world will come closer together after going through a rough patch. But, these are complex topics.
Why do we need national sovereignty or continent sovereignty around your Helsings for Europe and Andurils for the US? Why is that important? Anduril sell in Europe?
What if the US says, we're going to disable Anduril in Europe? You need independence. If we can't guarantee that the Anduril solution works, regardless of what people do in the US, we cannot trust it. And I think if you're thinking about anything else which has access to vast amount of information, if we talk about anything that gets visual, audio information, robots, cameras, we probably want to control who has access to the information we gather and who has access to a kill switch.
Robots, intense information, defense, space, energy. Okay? Do we have anywhere near the supply of capital currently today to fund this incredible depth of sovereignty supply needed?
Do you remember how much capital Germany allocated to this the last couple of weeks of February?
No.
I think it was between 1.5 and 2 trillion that Germany allocated just after the Zelensky White House meetings. These discussions are happening everywhere in Europe today. And the reality is we probably cannot use 2 trillion today. We need 1 trillion this year, 2 next year, over time. So I'm feeling...
Is that the right approach? Just like Germany saying, here's 1 trillion. What does that mean?
I mean, I do believe that we need to work together in Europe, but we need to work together maybe in ways which are slightly faster than the way we've done it before. Like if you think about some of the defense collaborations that have happened in Europe, they're very painful. Italy says, we will take part in this project, but this widget has to be produced in Italy. And that makes things very slow. Like if you look at how war has happened in Ukraine, You don't have time to go and bring some, you need to be building, iterating constantly. I think we need to be a little bit more modern about the way collaboration happens, but we do need to collaborate around Europe. And I think there's the capital, everyone is realizing that defense contributions, we were not at 2% in Europe before. Estonia was ahead, and Poland was ahead, but we need to get to 3, 4, 5% everywhere, and same in other critical industries.
Estonia, Finland, Baltic countries have been ahead for a while. To what extent is it a very real concern for you about Putin wanting to expand beyond where he is now?
I think it's a very serious, very real concern. We should be living under the assumption that whatever happened in Ukraine now, Russia will try in another country over the next years. And we need to be ready for this.
I hate this question, but I do kind of worry. Are we too far behind already? When you look at China and when you look at the supply of talent that they have, the depth of talent that they have, the control that the CCP has, the funding that they have, and America and what America have shown in the last few years, have we already faded into irrelevance?
I think that if we go back to the question around defense and timeline of a couple of years, I think if these budgets are unlocked soon, we can actually still get a lot done. But we need to, the urgency is higher now than it's ever been. And I think politicians at the highest levels are thinking about it in the same ways today. So I'm hopeful that they will come up with the right answers, but it's by far not guaranteed.
I don't think the political structures allow them to come up with the right answers in a way that's best for us in the long term. They are focused on a 4-year re-election cycle, and a lot of the projects that we're talking about are 10, 15 years out, and actually the capital requirements and prioritization strategies needed don't favor re-election.
I think it's a correct thing to worry about, but I think also we need to be more entrepreneurial and find ways to build things quicker. And I think it's doable. Look at Helsing. It's a 4 or 5-year-old company. They've built a lot. If we're looking like we invested in the exploration company working on space, they are 2-3-year-old company. So I actually think a lot is doable in a short amount of time if there is the right capital available for this. So right talent and right capital. And in terms of both, I think we are in a better place in Europe than we've ever been.
If we go through problems that we need to overcome, what do you think are the single biggest barriers we need to overcome in the race against China and the US?
A lot of this comes down to sufficient early stage capital for deep tech companies. So crazy investments that we like to do in Plural. If we're looking at, for example, Proxima Fusion building a fusion power plant, the most advanced fusion company in Europe. And by the way, the new German government has said they want the first not 1 but 2 fusion power plants to be built in Germany. So we're seeing there is a political will to act now as well.
Okay, so more deep tech cash earlier in Europe. We're not ambitious enough. If we often get told, hey, we don't work hard enough. The other one is, oh, you're happy with a 50 million sale or an
Harry, we don't brag about it as Americans do. That's the difference between Europeans and Americans. We're too humble. And I think, we need to learn to become better marketeers. Absolutely. Maybe we need to hire American marketeers.
Another that I never have an answer for, and it's the regulatory hurdles that come from a fragmented Europe being a barrier to stopping us. To what extent do you think that is a very valid problem?
2 ways to look at it. No entrepreneur ever has not started a company because of regulation. The best entrepreneurs, they go through walls made out of titanium to make it happen. So I think, in some sense, it's an excuse. But on the other hand, Europe is a fragmented market of I don't know how many countries. we need to streamline things. I'm excited to see there is like, what is it, 28th regime that Andreas Klinger is doing with EU Inc. That's great, But we need even more to make Europe a more unified market. Labor, capital. Like, why do we need to have a stock exchange in Amsterdam? Great companies listed there. London, Estonia. I mean, I would love there to be
an Estonian stock exchange.
Unfortunately, yes. I mean, I would love there to be a single global stock exchange. Maybe we could build it on the thing called blockchain.
I asked Julia Hoggett, the CEO of the London Stock Exchange, whether we should have a European stock exchange. When you look at the stock exchanges across Europe, they're all subpar and they're all subscale. I was met with a frosty reaction. Let's put it that way. Do you regret going public in London?
I don't regret going public in London. I think Wise is an example of a company that is well known amongst the investor universe that can go public anywhere. Adyen went public in Amsterdam. Whoever knew they have a stock exchange? They've done very well. Wise has done very well in the UK.
Do you think
it's been a passive up and down, but that's something which I think would have happened similarly in the US.
Do you think you would have a pricing premium if you're in the US?
I don't believe Wise would have a pricing premium in the US. We spent a lot of time agonizing this over the years before the IPO. So I think for Wise, it has worked out well. However, structurally, we have a lot of issues here. We don't have enough retail participation in the UK. We don't have enough institutional participation from the pension funds. So I do think the UK stock market is subprime in that sense. And I think, if you are a retail product, you want your consumers to buy you, so it makes sense to go public in the US. But I also think in some sense, maybe some of this is a bit of a wrong thing to spend so much energy on. Wise would have gone public in the US. Result would be the same. We would not be paying more tax in the US. We would still be headquartered here. So sometimes it feels to me people love to talk about this, but I'm not sure how big is the actual difference for certain companies.
Do you think Nick should go public in London? He's built the business in London. The team primarily is London HQ'd. Do you think you have a duty to go public in London?
I don't know. I don't know what duty Nick feels. So I can't answer on this.
What would you...
If he wants to build a big... I think here's what I would tell Nick. If he wants to build a big business in the US, then he should go public in the US.
Can I ask, you're a very wise, thoughtful, premeditated person in a nice way. When you go public also, after lockups, you have liquidity. Just out of interest, like for me personally, how did making money change your mindset, approach to life, approach to relationships? How did it change who you are?
Frankly, I think it has not changed. I have realized, I have generated liquidity through the years from Wise. I mean, not until we were valued at billions. I didn't sell a single share of secondary, but after that, I've done it in a, I would say, systematic way. I was also lucky to make money from being the first employee at Skype from stock options. So in that sense, I've been financially independent since 2002-3.
Does it change your mindset though?
I'm all interested in the upside.
Yeah.
And I'm interested in what are the good things I can do with the returns.
But I wasn't before. I was like, I need to pay for my family's home, and do you know what I mean?
Of course, I think for everyone, once you get through that moment, that's super important. Once you get through the moment of, I don't need to go to work for the monthly paycheck. I think that is an incredibly powerful moment for everyone.
Final one: if you were to sit in a room with the leaders of Europe and say, okay, US, China, we need to compete. This is what we should do from here to change. Are there any policy changes that you would recommend to make us as competitive as possible?
More capital for deep tech investment. Look at encouraging entrepreneurship. Look at reducing the regulatory burden. And I think the way we do government purchasing decisions, whether it's in defense or other areas, the government should be the biggest customer for European startups.
Cost plus is one that I've talked a lot about before. It's a challenge. Listen, I want to move into a quick fire because otherwise I could talk to you all day. So I say a short statement. You give me your immediate thoughts. Sound okay?
Yeah, let's try.
Okay. What do you believe that most around you disbelieve?
Estonia is a fantastic country. We have the biggest number of unicorns per capita, and nobody knows this.
Why do you think that is? Like, what is in the waters of Estonia?
We had great education during Soviet times. And I think we had an early start thanks to Skype. The ecosystem acceleration from an early success story is humongous.
Which company today in Europe do you think will be the biggest accelerator in the way that you mentioned there with Skype?
I mean, I have to say there seems to be a lot of companies coming from Revolut today, which is pretty cool to see. I don't know how many of them are doing exciting things compared to trying to do fintech widgets, but maybe today I'd say Revolut. I mean, Wise has a fair share of startups. Monzo has been great. Spotify, I don't know, top of my head. Must be.
Spotify's been pretty good. Yeah. What buy in the public markets would you make for a 10-year period? What's your buy and hold?
Oof. I have never bought the public stock.
What?
That's really hard. For 10 years?
Yeah.
I mean, actually, maybe I would go very classic Berkshire Hathaway for 10 years. I think that is going to compound in a much more predictable way if it's the only thing I'm allowed to hold.
I love that. You haven't bought a public stock? Wow.
Lots of private stocks.
What have you changed your mind on in the last 12 months?
I've become a whole lot more optimistic on Europe. I think, frankly, everything that has happened in relation to US, I've become so much more bullish on Europe. We will rebuild the critical industries.
When you look at your best investment, we mentioned Bolt earlier. Is there another one that you think will be the standout?
Maybe Synthesia. I made a pretty big angel investment early on when it was two crazy guys. AI was... I don't think the abbreviation AI was used. They were doing video generation using smart engineers. They've done an amazing job and still early in the journey.
Tell me, if everything goes to plan with Plural, what happens? What does the world look like then?
$1 trillion European companies.
In 10 years?
We will see.
Taavet, listen, thank you so much for this. I love it when conversations bluntly don't go to plan. It's always the joy of what I do. I've wanted to do this one for a long time, so I really appreciate you taking the time, and this has been fantastic.
Me too. Thank you, Harry.